All right, let's break down one of the most interesting and honestly kind of weird earnings reactions we've seen this season. We're talking about Ulta Beauty. They came out with fantastic second quarter numbers, but the stock just got hammered. It's a paradox, and it tells us there's a much bigger story playing out here about a company right in the middle of a huge transformation.
So that's the big question, right? Ulta absolutely crushed it. This is the kind of report that should send a stock to the moon. Instead, it dropped over 7%. So what gives? What did the market see that just wasn't in those headline numbers? Well, let's get into it.
Okay, so check this out. It really puts the puzzle in perspective. On one hand, you've got a massive 13% beat on earnings per share. I mean, that's just fantastic. But then you look at the market's reaction. Bam! A drop of over 7% the next day. This is a classic case of sell the news, and it tells you the real story here isn't about the amazing quarter they just had, but all about what's on the road ahead.
Now, before we get into all the concerns and the drama, we really have to give credit where credit is due. By pretty much every metric, this was an absolutely stellar quarter for Ulta. So let's start by breaking down just how good this performance really was. First up, the bottom line, and it was a knockout. GAAP diluted EPS came in at $5.78. You know what Wall Street was expecting? Something around $5.10. That's not just a beat, that's a home run. It really points to some incredible operational efficiency going on behind the scenes. And that strength wasn't just in the profits. The top line, the sales number, was just as strong. Revenue grew a super healthy 9.3% from last year, hitting almost $2.8 billion. That shows you there's real momentum here, and customers are definitely still spending. Okay, now for any retailer, this is the number that really shows you the health of the core business. Comparable sales. They grew by a really robust 6.7%. But here's the really cool part, it's how they grew. The growth was perfectly balanced. It came from more transactions, so more people were shopping, and a higher average ticket, meaning everyone who shopped spent more. That combo is just so powerful. And of course, the CEO, Kecia Steelman, was quick to say, hey, this wasn't just a fluke. She pointed directly to their big Ulta Beauty Unleashed strategy. Basically, this is management telling us that their plan to make the stores better and their marketing sharper is actually working. It's delivering real, tangible results. And this success was just everywhere. It wasn't one hot product carrying the whole company. Fragrance was on fire with double-digit growth. Skincare and wellness also had high single-digit growth. And even in those super competitive makeup and hair care spaces, they grew solidly. To top it all off, their loyalty program, get this, grew to a record 45.8 million members. I mean, this was just an A-plus quarter, top to bottom. Okay, which brings us right back to that paradox. If everything was so great, why on earth did the stock get clobbered? Well, this is where smart investors know to look past the rearview mirror of Q2 and listen very, very carefully to what management says about the future. The market wasn't reacting to the results, it was reacting to the guidance. And right here, you can see it plain as day. It really is a tale of two halves. On the left, you've got those amazing Q2 results we just went through. But on the right, that's the reason for the sell-off. The outlook for the rest of the year is just so much more cautious. Management is guiding to a huge slowdown in sales growth and a noticeable drop in their profit margins. That sudden deceleration is exactly what sent a chill through the market. So the key phrase here is this idea of operating margin normalization. It sounds like a bunch of corporate jargon, but what it really means is that management is resetting everyone's expectations for how profitable Ulta can be long-term. Remember those peak 14-15% margins they used to have? Well, they're signaling that those days are over. The new normal is going to be closer to 12% because of rising costs and big investments they have to make. For Wall Street, hearing lower long-term profits is a major red flag. And this quote from the CEO pretty much sealed the deal. Even after that great quarter, her tone was super cautious. She's talking about an uncertain economy. She's talking about pressure on what consumers can spend. You know, when a CEO sounds that cautious right after a huge beat, investors listen, and they usually get nervous. All right, so this cautious guidance, it isn't just happening in a vacuum. It's all part of a much bigger picture. Ulta is right in the middle of a massive strategic reshuffle, making some really big moves that are going to define their future. Let's take a look at what that is. And wow, this timeline really shows you how much is changing. They just jumped into the UK market by buying Space NK. They're about to launch a whole new online marketplace. And then there's the big one. They announced the end of their huge shop-in-shop partnership with Target. So you can see Ulta is planting new seeds for growth, while at the same time, they're pruning a really major existing branch. Let's really zero in on that Target exit, because it's a huge piece of this puzzle. Now, the revenue impact, it's tiny. We're talking less than 1% of their sales. But, and this is the crucial part, look at that EBIT margin flow-through, a massive 60 to 65%. This was an incredibly high-profit royalty stream, basically free money for them. Now, management says they're confident they can replace it, but for investors, losing that kind of easy, high-margin revenue creates a huge question mark. So let's put this all together. You've got a fantastic quarter, but a really cautious guidance. You've got a reset on how profitable the company can be, and a huge strategic shuffle going on. So what does all this mean for the company and for the stock? Let's get into our forecast and our rating. Looking ahead, for the rest of this year, we expect their sales growth to probably come in at the low end of that new, lower range. We think they'll hit their earnings goals, but don't expect another one of these huge upside surprises. The key metric everyone's going to be watching like a hawk is the pressure on their profit margins from all their new spending. And on the next call, you can bet investors will be laser-focused on any updates about that Space NK integration. So what does this mean for the stock price? Well, honestly, expect more choppiness. The market is still trying to figure out how to value Ulta with this new, lower profit reality. We think the stock is probably going to trade sideways, kind of in a range, until management can give a much clearer picture of what's going to drive growth in 2026, especially after that Target partnership officially ends. And for all those reasons, we are initiating our rating at market perform. Look, the company is doing a solid job running the business day to day, and management is making some proactive changes. But the stock just seems fairly valued right now, given all the big uncertainties around their future profitability and all these strategic changes they have underway. And that really leaves us with the one big ultimate question that is going to define the next chapter for Ulta. Can all these new ventures, going international, the new online marketplace, can they generate enough high-margin growth to not only replace the easy money they're losing from Target, but also to convince investors that a whole new, sustainable era of growth has begun? That is the multi-billion-dollar question that Ulta now has to answer. This is not financial advice.